closed deals, you're seeing the major averages are all pushing higher this morning, led by the Dow, which is up about 0.25% already this morning. Keep in mind, year to date, the return on the Dow right now is just under 7%, as it is for the S&P 500 and the Nasdaq, both of which are also higher today. What has been higher and what is this year's best performing commodities may actually be the worst by December. Some traders think that higher supplies of commodities like copper, nickel, and lead are outpacing the actual demand. One calls it a real bubble and says that it's going to burst. The bears are convinced that demand is going to decline, and they think that that's partly because of the biggest user of them all, China, which is trying to cool down its economic growth. We've got Morgan Stanley's economist Stephen Roach, who's pointing out that demand is also weakening as the U.S. economy slows down, and the manufacturers are looking for alternatives to copper and nickel, which have skyrocketed so far this year. So to talk a little bit more about this theme, we've got Jeff Sott still with us, and we want to bring in Kevin Kerr, who is the president of Kerr Trading and editor of Resource Trader Alert. It's a commodities newsletters for his investors, and he's coming to us from Connecticut this morning. And Kevin, let's start off with you. When I'm looking at the chart here on the Bloomberg screen, nickel is up almost 69%, and that's just year to date. We've got copper up 33%, lead is up 27%, and it continues from there. Cocoa, gas, heating oil, all of them substantial gains, but really something like nickel, copper, and lead are outshining the market, if you will. What do you think has been behind this run, and what is the likely outcome of it?
Well, you know, it's hard to predict what the outcome will be. The base metals have always been a favorite of mine. They're difficult to trade for many people, but, you know, like you pointed out, this year so far has been incredible for a commodity like nickel. I think we've heard this bubble, bullish, the run's over argument before. JP Morgan came out at the beginning of the year, and of course they missed those 67% or 69% gains, the people that followed that advice, saying that we were at the top back then. Longer term, we remain bullish on this. The reason is simple. Demand for these commodities remains high. Yes, there are alternatives. You know, I'm a firm believer that commodity demand destruction happens when commodities reach a certain price and that commodity no longer makes sense. Certain commodities may be there. I don't know which ones all the time. We try to figure it out. That's our job.
Well, let me ask you, how are you trading this then? How are you trading nickel, which is up 69%? How are you trading copper, which is up 33%?
We will look at opportunities. We use options primarily in many of these metals markets, gold, silver, copper, whatever it may be, and we will sell when we see the market get overbought, and then we will buy back in on the dip. We can do this all year long, and we've seen it repeatedly work. It's not
overbought right now?
I don't feel that some of those base metals are. I think, in fact, if you want to refer to copper, I think a large reason, and many of our analysts do, the reason that you've seen copper pull back is China has slowed down a little bit in their buying. And for a perfect reason, they want to see prices pull back, and they're getting what they want. They could come back in at any time and ramp up the buying, and this could be a moot point.
Jeff, in terms of on the equity side, how does an investor play this? Which are the particular companies that you think will continue to benefit if investors really do believe that this is going to continue?
I've been bullish like Kevin has on nickel for the past 5 years. Interesting about talking about the demand cooling. The normal car uses about 2 to 5 pounds of nickel in it, but the hybrid cars use somewhere between 35 and 40 pounds of nickel because of their batteries. So there's been this scramble to buy nickel companies, Falconbridge, Ignico, NICO.
And do you I mean, these are companies that have advanced quite considerably.
Huge.
What does somebody do now? Can somebody still get in on this rally?
The large conglomerates, Rio down in South America, put a bear hug on some of the nickel companies. You've got BHP, probably the largest mining company in the world now. The old Broken Hill proprietary has a number of base metals in there. The smaller ones are indeed disappearing. We follow, my Canadian-based analyst team follows one called Canadian Royalties up in Canada, which has property right next to the Falconbridge properties. We have an outperform rating on that one.
All right. Kevin, as you're with us, you don't just trade the copper and the nickel, but you trade commodities across the board, and wanted to find out what's going on in some of the agricultural commodities, which were so hot, and that was all the talk, and now obviously that bubble has collapsed. Something like coffee down 19%, cotton is down 17%, sugar is off by 13%. What's going on in the agricultural commodities now?
Well, they all sound like bargains to me. I'll tell you the truth. A lot of these commodities we've seen in oversold conditions. Sugar, I think, is one of the bigger ones. And, again, it's been no harder for me to watch coffee because I did get long coffee at a much higher price. But I think we are seeing some oversold conditions in some of those key soft commodities. The grain markets have been on fire. This is another market we treat almost like we treat the metals. If we see corn rally too much, we will sell, take our profits, and buy on the dip. These are weather-related markets. Some of these are geopolitical markets, and really they're very interesting markets and very profitable markets. But you have to be flexible. And the beauty of futures and options is you can trade both sides just as easily. So it doesn't matter.
What are you doing? Let's talk about corn specifically. What are you doing specifically with corn right now, which is down 8% year to date?
We have futures and options on corn. We are basically long out to 2008. Again, we are very conservative. We will take half profits on our positions when they reach 80, 90% profit or 50% profit, 100% profit. We'll be all out and then wait for the market to pull back and re-enter. This is just an ongoing strategy we use. It's been very, very, very good. And we expect this summer, if weather conditions dry up again, we'll see corn rally even higher than this. It doesn't matter that it's high already. It could go even higher.
Kevin, thank you very much. We appreciate your time. And please stay with us, everybody. We're coming right back talking about the global economy after this.